Welcome to another episode of Thailand Truth Talks. Welcome back to Thailand Truth Talks. I'm here walking through the streets of Bangkok. Same streets, same heat, same dream that thousands of Western expats chase every year. But here's what most people don't realize as they're planning their Thai retirement fantasy. The country you're coming from might determine whether you live comfortably here or get financially hammered by taxes you never saw coming. Over the past 4 episodes, we've dissected the tax treaty situations for Americans, Canadians, Brits, and Australians. And I've been reading your comments. Thank you for engaging. Some of you are saying, come on, aren't all these treaties basically the same? Why does it matter? Let me be crystal clear. No, they are absolutely not the same. And that misconception is exactly why I'm making this final episode. Because the difference between a favorable treaty and no treaty at all could cost you 15 to 35% of your pension income every single year for the rest of your life in Thailand. This is the reality Thailand doesn't advertise when they're trying to lure wealthy retirees with their retirement visas and tropical paradise marketing. Remember the narrative we've been tracking throughout the series. Thailand's policies increasingly suggest they want rich expats, not middle-class or working-class retirees. Today, we're going to see exactly how that plays out for Europeans, Latin Americans, and others who thought their pension was safe. Before we dive into specific countries, everyone needs to be reminded and understand that what changed on January 1st of 2024, because this is the earthquake that's reshaping expat life in Thailand right now. For decades, Thailand had a loophole. If you earned money abroad in one year and brought it to Thailand in a different year, you paid no Thai tax on it. That's over. Starting January 1st of 2024, any foreign-sourced income remitted to Thailand is taxable, regardless of when you earned it, unless you can prove the money was sitting in your foreign bank account before December 31st of 2023. Let's talk real numbers. If you're on a retirement visa, immigration requires you to show either 65,000 baht per month income or 800,000 baht in a Thai bank account. That's 780,000 baht per year minimum. Under Thailand's progressive tax system, after the 150,000 baht exemption, you're looking at a potential tax bill of 71,000 baht per year, about $2,000. But here's where your country of origin becomes critical. A good tax treaty can reduce that to zero. A bad treaty or no treaty, you're paying the full amount and possibly getting hit twice. Once by Thailand and once by your home country. The Thai Revenue Department has made it clear you must file a tax return if you're remitting foreign income to Thailand, even if you think you're exempt under a treaty. And as Thailand signed up to the Common Reporting Standards in 2020, they're now receiving automatic financial data from over 130 countries. They know what's in your foreign bank accounts. The days of flying under the radar are gone. Let me be specific about what this means. Every year, likely in September or October, Thai tax authorities receive a massive data file containing information about every foreign financial account held by Thai tax residents. This includes your bank balances, interest earned, dividends received, and account transactions. Your bank in France, Germany, or Spain is legally required to report this information to their government, which then automatically shares it with Thailand. The Thai Revenue Department is building profiles. They can see if you declared 780,000 baht in remittances, but your foreign accounts show you had 5 million baht in income that year. They can track patterns over multiple years. And here's the critical part. Just because they haven't contacted you yet doesn't mean they won't. Tax authorities often wait years to build cases before enforcement action. Let me tell you about the expats who won the geographic lottery. These are people from countries with what I call Category 1 treaties, agreements that explicitly state foreign pensions are taxed only in your country of residence, which for you would be Thailand. But wait, Thailand then agrees not to tax that pension at all. Sound too good to be true? It's not. It's just extremely specific to certain countries. Ireland. The 2016 treaty with Thailand is beautifully clear. Article 18 states that pensions paid to a resident of Thailand is in consideration of past employment shall be taxable only in that state. But Thailand agrees to exempt it. Irish retirees living here pay their Irish tax on pensions back home, but Thailand doesn't touch it. Zero Thai tax on your Irish pension. The Netherlands. Their 1976 treaty, yes, nearly 50 years old, but still gold, contains virtually identical language. Dutch pensioners in Thailand are in the same blessed position. Pay your Netherlands tax, remit your pension to Thailand, sleep soundly. The Thai Revenue Department cannot tax it. Chile. Here's an interesting one. Thailand's 2010 treaty with Chile explicitly provides that pensions arising in a contracting state and paid to a resident of the other contracting state shall be taxable only in that other state. And Chile isn't just a Category 1 country for pensions. Chilean citizens also benefit from a bilateral visa exemption deal, allowing stays up to 90 or even 180 days per entry. Smart planning here could mean extended stays with minimal tax exposure. Norway. This is where it gets interesting, and where you see the real difference between treaties. Norway's 2003 treaty with Thailand regulates pension taxation in Articles 18, 19, 22, and 23. If you live in Thailand, your Norwegian pension is taxed in Thailand, but Norway provides relief by not taxing the amount that Thailand already taxed. Here's the clever part. Thailand's progressive tax rates start at 5% and climb gradually, while Norway charges a flat 15% rate for pensioners living abroad. A Norwegian retiree can declare their pension in Thailand, pay the lower Thai rates on the amount needed for living expenses, and structure their finances to minimize total taxation. This is sophisticated tax planning, but it works because the treaty has clear mechanisms built in it. New Zealand. Now here's a country many of you have asked about. New Zealand has a tax treaty with Thailand dating back from 1998, and it's solidly Category 1 for pension income. The treaty provides that pensions and annuities are taxable only in the country of residence. For Kiwis retiring to Thailand, this means your NZ superannuation is taxed in Thailand only, not in New Zealand. However, there's a catch many don't realize. You need to understand the difference between NZ superannuation, the government pension, and private retirement savings like KiwiSaver. The treaty treatment may differ, and this is exactly why you need expert advice specific to your situation. Japan and Singapore. While not Western in the traditional sense, these are major source countries for Thailand expats, and many English-speaking expats work in these countries before retiring. Japan's 1990 treaty is Category 2. It exists, but it's old and the pension provisions are ambiguous. Japanese retirees often face complicated situations because Japan's tax system is complex and the treaty doesn't provide clear exemptions. Singapore is fascinating because it has no tax treaty with Thailand. Zero. This shocks many people because Singapore is geographically close and economically significant. Singaporean retirees or former Singapore-based expats face full Category 3 conditions. Given that many Western expats spend career years in Singapore building up retirement savings, this is a nasty surprise when they try to retire in Thailand. What do these Category 1 countries have in common? Their treaties explicitly protect pension income with clear residence state-only language. And they're generally newer treaties negotiated after 2000, or they've been updated to reflect modern standards. The benefit is enormous. You avoid double taxation completely. Investment income like dividends and interest also gets better treatment with lower withholding caps. If you're from Ireland, the Netherlands, Chile, or Norway, Thailand's 2024 tax changes barely touch you. Now, let's talk about the majority of European expats. This is where things get messy, and where your comments about treaties being the same completely miss the mark. France. The 1975 treaty contains Article 18 on private pensions. But here's what it says. Pensions may be taxed in the first mentioned state, not shall only be taxed. May be taxed. The vague language leaves the door wide open for both France and Thailand to tax your pension. What does this mean in practice? French retirees remitting pension income to Thailand after January 1st of 2024 could face taxation in both countries. You'll file your French tax return, pay French taxes on your pension, then you'll file your Thai tax return and owe Thai tax on whatever you remitted. Your only relief comes from claiming a foreign tax credit, which is complex, requires extensive documentation, and may not cover the full amount depending on the tax rates in each country. Germany, Spain, Italy, Belgium, Finland, Luxembourg, Hungary, Switzerland. These countries fall into this same Category 2 trap. Their treaties exist, but they're old, they're vague, but they don't provide clear pension exemptions. Treaty language varies dramatically. Some specify different time limits and have different conditions regarding domicile. Some treat retirement fund remittances differently from pension payments. The details matter enormously. Let me give you a concrete example of why this matters. Let's say you are a German retiree bringing 65,000 baht per month into Thailand, the minimum for a retirement visa, or 780,000 baht yearly. With the 150,000 baht personal exemption, you have 630,000 baht of the taxable income in Thailand. Here's how it breaks down. First, 150,000 baht after exemption, 5%, equals 7,500 baht. Next, 200,000 baht, 10%, equals 20,000 baht. Next, 250,000 baht, 15%, equals 37,500 baht. Remaining 30,000 baht, 20%, 6,000 baht. Total Thai tax, 71,000 baht, about 2,000 US dollars. Now, you've probably already paid German tax on that same pension. Can you claim a credit in Thailand for the German tax paid? Maybe. Can you claim a credit in Germany for the Thai tax paid? Depends on German law and how you structure your residency. Do you see the problem? You're filing returns in two countries, paying accountants in two countries, potentially getting taxed in two countries, and the treaty that's supposed to prevent double taxation doesn't actually prevent it. It just provides a mechanism to claim credits, which may or may not fully compensate you. This is not the same as a Category 1 treaty, not even close. So let's be honest about what this means for middle-class retirees. If your pension is modest, say 50,000 to 70,000 baht per month, that additional 71,000 baht annual Thai tax bill, combined with foreign accountant fees and the stress of dual country tax compliance, might be the difference between comfortable retirement and struggling to make ends meet. This is what I mean when I say Thailand's policies show they don't want poor or middle-class Westerners anymore. The wealthy don't care about a 71,000 baht tax bill. They have accountants handling it. But for someone on a fixed pension, this is brutal. Now we get to the harshest category, countries with no tax treaty with Thailand whatsoever. And surprisingly, this includes several Western nations and most of Latin America. Mexico, no tax treaty with Thailand, period. If you're a Mexican retiree here, every baht of pension income you remit to Thailand is fully taxable under Thai law. With no treaty protection, you'll pay Thai tax on remitted amounts with no automatic relief or credit entitlement. Meanwhile, Mexico will also tax your pension under Mexican law. You're essentially relying on Mexico's domestic law for any unilateral foreign tax credit, which is limited and retrospective. Brazil, same situation, no treaty. Brazilian retirees face full Thai taxation on remittances plus Brazilian taxation on the same income. And unlike Mexicans, Brazilians don't even have visa-free entry benefits to help them optimize their time in Thailand. Argentina. Here's an interesting case. Argentina has no tax treaty with Thailand, so Argentine retirees face Category 3 conditions. However, there is a bilateral visa exemption agreement allowing Argentine citizens extended visa-free stays, reportedly up to 90 or even 180 days per entry. Think about the strategy this enables. An Argentine retiree could spend 5 to 6 months in Thailand each year as a tourist, keeping their pension in Argentine accounts and using ATM withdrawals or credit cards for daily expenses, never becoming a Thai tax resident, which requires 180 plus days, and thus avoiding Thai taxation entirely. It's legal, it's viable, but it means you can never truly settle here long term without facing significant tax consequences. Greece, Slovakia, Uruguay, and most of Central America, no treaties, all face the same Category 3 challenges. Let me paint you a real-world picture of what Category 3 looks like day to day. Imagine you're a Greek retiree who spent your career building up a modest pension. You've dreamed about Thailand for years, the weather, the cost of living, the lifestyle. You sell your Athens apartment, get your retirement visa, move to Chiang Mai. Month 1, you transfer your pension payment, let's say 50,000 baht, to your Thai bank account. Under Greek law, Greece taxes this pension. Under Thai law as of 2024, Thailand also taxes this remittance. You have no treaty to prevent double taxation, no automatic credit mechanism, no clear legal pathway to relief. By month 3, you realize you need to file a Thai tax return. You find an accountant who charges 15,000 baht just to file. You discover you owe approximately 50,000 baht in Thai taxes for the year on your remitted pension. Combined with a Greek tax bill, you're losing 25 to 30% of your pension to taxes and compliance costs. The cheap cost of living in Thailand suddenly doesn't look so cheap when you're bleeding money to 2 different tax authorities with no treaty protection. This isn't a hypothetical scenario. This is the reality for thousands of expats from non-treaty countries right now. The practical implications are severe. Without a treaty, no automatic exemptions or reduced rates, no guaranteed foreign tax credits, no bilateral mechanism to resolve disputes. You're subject to Thailand's full progressive tax rates on all remitted income. Your home country taxes you according to its own rules with no coordination. Many retirees in this situation adapt by keeping funds offshore, only transferring amounts up to personal exemption limits, or timing remittances around their residency status to minimize tax years. But these workarounds require constant vigilance and often mean you can't fully integrate into Thai life because you're always managing your visa and tax exposure. Some of you are thinking, this sounds complicated, but maybe I can just stay under the radar. Let me tell you why that's incredibly risky right now. Because Thailand joined the Common Reporting Standards in 2020, as mentioned earlier, they automatically receive financial account information from over 130 countries. Banks in Europe, North America, and elsewhere are required to report your account balances and transactions to your home country, which shares that data with Thailand if you're registered as a Thai resident. The Thai Revenue Department isn't guessing whether you have foreign income. They're receiving data dumps. They know. Second, enforcement is ramping up. Foreign residents must file income tax returns for 2024 by the end of March 2025. This is the first full tax year under the new rules. The Thai government is actively expanding their tax base to deal with an aging population and an economic restructuring. They're not collecting this data for fun. Third, getting it wrong has real consequences. Penalties for non-compliance can be severe. And if you think you can just leave Thailand and start over somewhere else, many countries now share tax enforcement information. Once you're on the list, you're on a list. Let's zoom out for a moment. Over 5 episodes, we've analyzed tax treaties with the US, UK, Canada, Australia, and now the rest of the Western world. What's the pattern? Countries with newer treaties, post-2000, generally have better pension protections. Countries with old treaties, 1970s to 1990s, have vague, problematic language. Countries with no treaties face full double taxation, with no systematic relief. Thailand has 61 double taxation agreements worldwide, but the terms vary dramatically. This isn't an accident. Thailand negotiates based on what they think they can get from each partner. Wealthy Nordic countries with strong negotiating positions get favorable terms. Smaller countries or those less important to Thai economic interests get weaker treaties or none at all. There are hints Thailand will renegotiate or expand DTAs to attract wealthier retirees. For instance, news suggests Norway and Thailand are negotiating an updated convention. But notice what's happening. They're updating agreements with rich countries. They're not rushing to sign treaties with Mexico, Brazil, or Argentina. They're not retroactively improving the 1975 French Treaty. The message is clear. Thailand wants wealthy retirees who can afford tax compliance costs and won't blink at a 71,000 baht annual tax bill. The long-term resident visa program exemplifies this. It offers complete foreign-sourced income tax exemption by royal decree. But the eligibility requirements are designed for the wealthy. For middle-class pensioners from countries with Category 2 or Category 3 situations, life is getting harder, not easier. If you're planning to retire in Thailand or you're already here, stop thinking you can figure this out from YouTube videos and expat forums. I'm serious. Here's what you need to do. And before anyone comments, you're just fear-mongering, or I've been here 10 years and never filed taxes. Understand that what worked before 2024 doesn't work now. The game has fundamentally changed. CRS data sharing is real. The January 2024 remittance rules are being enforced. Your 10-year streak of flying under the radar is actually building up a larger potential liability that could come due all at once. I've personally spoken with expats who received demand letters for 3 years of back taxes simultaneously. We're talking assessments of 500,000 to 1 million baht, including penalties. These aren't theoretical scenarios from tax seminars. These are real people in Pattaya, Chiang Mai, and Bangkok right now dealing with Revenue Department enforcement. The time for casual neglect is over. Here's your action plan. Determine your exact treaty status. Don't assume. Look up your specific country's treaty with Thailand. Read the actual pension article. It's usually Article 18 or 19. The exact wording matters. Shall be taxable only in is completely different from may be taxed in. If you can't understand the legal language, that's a sign you need professional help. Calculate your real tax exposure. Factor in Thai progressive tax rates on your expected remittances. Your home country's tax on the same pension income. Whether you can claim foreign tax credits in either country. Compliance costs, accountants, tax preparers in multiple countries, currency exchange risks over time. Understand your residency status. Thai tax residency requires 180 plus days per year in Thailand. If you're in Thailand for fewer than 180 days annually, you're only taxed on Thai-sourced income. For some nationalities, especially those with visa exemption agreements, but no tax treaties, strategic travel could be your best tax planning tool. Hire real expertise. And I don't mean some expat forum guru or the accountant back home who does your simple return. You need someone who understands Thai revenue code and current enforcement, your home country's tax law, the specific treaty, if any, between the two countries, cross-border tax planning strategies, CRS reporting requirements. This costs money, yes, but getting it wrong costs far more. Let me be brutally honest about what professional help actually means and costs. You're looking at a minimum of 30,000 to 50,000 baht annually, possibly more, for competent cross-border tax advice. That's for basic compliance, preparing your Thai tax return, coordinating with your home country filing, documenting treaty positions, and handling any revenue department queries. If you have complex situations, multiple income sources, investment accounts, rental properties, business interests, you could be looking at 100,000 plus baht annually in professional fees. Add another 15,000 to 30,000 baht for your home country accountant who needs to coordinate with the Thai side. Is this expensive? Absolutely. But consider the alternative. Incorrect filing could result in penalties of 100 to 200% of unpaid taxes, plus interest. One expat I know got hit with a 400,000 baht assessment because they didn't properly document their treaty exemption claim. Their savings from not hiring an accountant in year 1 cost them 500,000 baht in year 3. And here's what most people don't realize. Even if you have Category 1 treaty with clear exemptions, you still need to file and claim those exemptions properly in Thailand. The exemption isn't automatic. You must submit the correct forms, provide supporting documentation, possibly get a certificate of residency from your home country, and properly reference the specific treaty articles. Miss one step and the Thai Revenue Department defaults to full taxation on your remittances. As one tax advisory notes, tax matters are intricate, especially when dealing with two countries. Given these changes, consulting with a highly skilled and experienced expatriate tax firm can assist you in navigating the complexities effectively. This isn't optional anymore. It's essential. Document everything. If you have pre-2024 savings in foreign accounts, keep meticulous records proving those funds existed before December 31st of 2023. Bank statements, year-end balances, transaction records, all of it. You may need to prove the money was sitting overseas before 2024 to avoid Thai taxation on those old savings when you eventually bring them to Thailand. Don't just follow what others do. Your German neighbor might be fine. That doesn't mean you will be. Your Canadian friend's situation is different from your French situation. The Irish couple you know has a completely different treaty than your Belgian treaty. Every country is unique. Every person's income sources are unique. Generic advice from expat groups is dangerous because people assume their treaty is basically the same as everyone else. As we've proven over 5 episodes, they're not. So here I am, walking the streets of Thailand, making these videos. But I'm not going to lie to you about what's happening. Thailand is actively restructuring its tax system to extract more revenue from foreign residents while simultaneously making life easier for the ultra-wealthy through programs like the LTR visa. The January 2024 rule changes weren't targeted at expats specifically, but the effect on middle-class Western retirees is significant. Combined with tightening visa requirements, increased financial proof demands for retirement visas, and now aggressive tax enforcement through CRS data sharing, the picture is clear. Thailand wants you here if you're rich. If you're middle class or working class, you're tolerated, but you're going to pay for the privilege. The irony: countries with older, favorable treaties are often keeping quiet or not updating their agreements because they benefit Thai residents. Meanwhile, countries that would most benefit from renegotiating better pension protection, those with large but not wealthy expat populations, lack the leverage to demand better terms. Your Category 1, 2, or 3 could literally be the difference between a comfortable retirement and financial stress, between staying in Thailand long term or having to leave because tax costs destroy your budget. So to everyone who commented that these treaties are all the same, I hope this episode has shown you how profoundly different they are. The Netherlands versus France, Norway versus Germany, Ireland versus Spain, Chile versus Argentina. These are not minor variations. These are fundamental structural differences that affect thousands of dollars annually. And here's something that really frustrates me. The expats who've been here for years dismissing newcomers' concerns because it all works out, or just don't worry about it. That advice might have worked in 2022 or even 2023. It doesn't work in 2025. The landscape has fundamentally shifted. What's particularly insidious is how Thailand implemented these changes. They didn't announce a major crackdown. They didn't send warning letters to existing expats. They just quietly updated the tax code on January 1st of 2024, joined international data sharing agreements, and started processing CRS data. Many expats won't realize they have a problem until they receive that first Revenue Department assessment letter, and by then, penalties and interest have already accumulated. This is classic policy implementation, designed to extract maximum revenue while minimizing public outcry. Change the rules quietly. Enforce them selectively at first to build case files. Then ramp up enforcement once the legal framework is firmly established. We're currently in that transition phase between selective enforcement and widespread enforcement. The question isn't if they'll come after non-compliant expats. It's when. Do your research. Know your specific situation. Hire competent legal and tax advice. Don't assume. Don't hope. Don't follow generic advice. Because Thailand Truth Talks isn't about scaring you away. It's about giving you the truth so you can make informed decisions. The dream of retiring in tropical paradise is still alive. But for many Westerners, especially those from Category 2 and 3 countries, that dream now comes with a tax bill that previous generations didn't face. That's the truth. That's what they don't tell you in their tourism campaigns or in the retirement visa websites. If this series has helped you, please like, subscribe, and share. Comment below with your country and let me know which category you're in. I'd love to hear from people living in these situations in real time. Until next time, stay informed, stay skeptical, and stay true to the reality of expat life in Thailand. This is Thailand Truth Talks, signing off from the streets of Bangkok.